Imagine waking up one morning and hearing this on the news. The United States has officially hit its debt ceiling. Government payments are now frozen. Financial markets are in turmoil. Sounds dramatic, right? But this isn't fiction. It's a real possibility that has threatened the global economy time and again. Today, we're breaking down what the debt ceiling actually is, what happens when we hit it, and why you should care, whether you're a student, investor, or just trying to pay your bills. Let's break it down. What is the debt ceiling? The debt ceiling is the legal limit on how much money the U.S. federal government can borrow to meet its existing legal obligations. That includes things like Social Security payments, military salaries, Medicare and Medicaid, interest on national debt, tax refunds, federal employee wages. Think of it like this. If the government were a household, the debt ceiling would be its credit card limit. And when you hit your limit, you can't borrow more, even if you need to pay rent or buy groceries. But here's the twist. This isn't about new spending. It's about paying for spending Congress has already approved. Yet every few years, Washington hits this limit, and the same drama unfolds. Will we raise the ceiling? Will we default? Will the economy collapse? It's like playing chicken, with the global economy in the passenger seat. What happens when the U.S. hits the debt ceiling? When the U.S. hits the debt ceiling, the Treasury Department can no longer issue new debt to fund government operations. So what happens next? 1. Emergency measures. First, the Treasury uses extraordinary measures. They pause certain investments and shuffle funds to buy time, usually a few weeks or months. But these are just temporary patches. 2. Government default risk. Once those measures are exhausted and there's no deal to raise the ceiling, the U.S. defaults on its obligations. That means the government starts missing payments. Federal employee salaries, veteran benefits, Social Security checks, debt interest defaulting on U.S. Treasury bonds, considered the safest investment on Earth, would send shockwaves around the world. Markets would tank. Interest rates would spike. Trust in U.S. financial stability would crumble. Let's get specific. If the U.S. can't pay its bills, what does that actually look like? 1. Financial market panic. Treasuries are the bedrock of global finance. A missed payment would cause panic selling, stock market crashes, a downgrade of U.S. credit rating, and investors would demand higher interest rates to lend to the U.S., which means more national debt in the long run. 2. Higher borrowing costs. When the government looks risky, everyone pays more to borrow. Mortgage rates rise. Credit card APRs increase. Auto loans get more expensive. Student loans see higher interest. It's a chain reaction, a ripple that starts in D.C. and reaches every American household. 3. Delayed payments. Millions rely on timely government payments. Social Security recipients, Medicare providers, military families, federal employees. If those checks are delayed, people miss rent, fall behind on bills, and consumer spending drops, pushing the economy closer to recession. 4. Job losses and recession. Less government spending equals shrinking GDP. Confidence drops. Businesses pull back. Layoffs follow. And during uncertainty, companies hoard cash instead of hiring or investing, slowing down recovery even more. This isn't a new issue. Let's look at some real history. 2011 debt ceiling crisis. Congress delayed raising the ceiling, leading to the U.S. credit rating downgraded for the first time ever. $2.4 trillion wiped from global markets. A spike in borrowing costs. Investor panic that was just from the threat of default. 2013 government shutdown. A standoff over the ceiling led to a 16-day government shutdown. National parks closed. Research halted. Workers furloughed. 2023 brinkmanship. Once again, Congress danced on the edge of default. The Treasury warned of a catastrophic default by June 5th. Markets braced, and emergency talks were held behind closed doors. Each time, a deal was reached. Just in time. But how long can we keep gambling? Why don't we just eliminate the debt ceiling? Good question. Most countries don't have a debt ceiling at all. The US is one of the few with this self-imposed limit. Critics say it's outdated, politicized, economically dangerous. It doesn't control spending. Congress already approves the spending in advance. The ceiling just determines if the government can pay for what's already been agreed on. Supporters argue it forces fiscal discipline. But in reality, it often leads to political games that endanger real people and the global economy. So, what should you do if this happens again? Let's say the headlines warn of another standoff. Here's what you can do. 1. Don't panic yet. Most standoffs are resolved at the last minute. 2. Review your emergency fund. If you rely on federal income, prepare for possible delays. 3. Avoid risky investments. Volatility rises during debt ceiling fights. 4. Lock in interest rates for loans before uncertainty pushes rates higher. 5. Diversify your income and savings. Don't be overly dependent on government payments or one market. In other words, build financial resilience before the storm. So, what happens if the US hits the debt ceiling? It's not just a Washington drama. It's a financial earthquake that can impact every American, from Wall Street to your street. Whether it's missed payments, higher interest rates, or job losses, the fallout is real. That's why we can't afford to ignore it. Want to stay informed and prepared? Subscribe to Money Blueprint, where we break down money, mindset, and major economic events in a way that makes sense. Like this video, drop a comment with your thoughts on the debt ceiling, and share it with someone who needs to understand what's at stake. Until next time, stay sharp, stay informed, and build your blueprint to wealth.